And as Manish mentioned, free zones also, we have regular free zones and finance free zones. But we also have a free zone concept called designated zone. We have seen this concept of designated zones or designated free zones in VAT law. So corporate tax law has given the reference to the same definition of designated zone that we have in VAT law, which means whatever free zones we identified as designated zone under VAT law become designated zones for corporate tax law also. But one thing we need to note here is that the ministry has not given yet the list of free zones. They mentioned only the designated zones list by giving a reference to VAT law designated zones. But for free zones, they have not given any list as such. So that's one area that we require clarity on. But yeah, a company which is established in a free zone company, if they want to get a status of qualifying free zone person, they're expected to meet all these conditions which I mentioned there on the slide. One of the important point to comply with is to have adequate substance in terms of office, employees, management setting here, and operating expenses being spent here. You need to make sure that these, whatever items I mentioned, in those respect, you have enough substance maintained in the free zone. So to the extent of the size, whatever you're mentioning. Second point is that you are deriving qualifying income. We will see what is the definition of qualifying income when you will be considered as deriving qualifying income in the following slides. Third point is to satisfy the de minimis requirements. That is also one of the points that we are going to discuss in the following slide. Fourth one is that free zone company has not elected to be subject to regular corporate tax rates. As we have seen, the regular corporate tax rates are like 0% tax on your profit up to 100,000, 375,000 dirhams, and 9% in excess of that 375,000 dirham profit. So this free zone company should not be electing to be subject to tax at those rates. Then only it will be qualifying to be or considered to be a qualifying free zone person. Next point is to comply with arm's length principles or transparency requirements. The previous slides we discussed about the arm's length principle concept. So if you have any transactions that you do with your connected persons or related parties, you need to make sure that those are dealt with at arm's length. You are taking care of the benchmarking requirement and complying with the transparency requirements. And the last point for to consider is to have your books of accounts audited. All the free zone companies, generally we have the requirement of having the books of accounts audited for the purpose of license renewal in most of the cases. Even for the qualifying free zone person status also, you are expected to have your books of accounts audited on regular basis. Once you comply with all these conditions, then you will be considered as a qualifying free zone person. So in general, by default, any free zone is considered as a qualifying free zone person, and you're also expected to comply with this. If any free zone company is not complying with this or is not able to meet this condition, so that company will not be considered as a qualifying free zone person in that year. Plus, in following 4 years, it cannot get the same status. So which means all your profit will be subject to tax in a normal rate, like 0% tax up to 375,000 profit, 9% tax in excess of that. And as I mentioned, the substance is what is required to be maintained in the free zone. This substance can be taken care either by your own company, which is a free zone company, or you can outsource this to a related party or a third party. But that related party or third party should be located in a free zone, and they should be able to take care of this particular compliance. So there is another important area to look at is that the free zone companies and the mainland companies have the respective or different rates of taxes. But there could be another rate, a higher rate of taxes, if a free zone company or a mainland company is part of a group, and that group has got a turnover of 750 million euros or more in a year. Then for that particular company, a group, the tax rate could be higher once the Pillar 2 of OECD is being implemented. So as Manish mentioned, UAE is also one of the country to the OECD or Organization for Economic Cooperation and Development. Once OECD decides to implement this Pillar 2 concept, in which case all those entities part of those groups will be subject to tax at higher rate than 9% or 0%. That higher rate could be effective to 15% of corporate tax. So this is not effective yet, but we foresee this to happen in 2024. As I mentioned, this is not for all the companies, but only for those companies which are part of that larger MNC groups. Now let's look at what is that qualifying income. which we have discussed in the previous slide, what all could fall under that. So income from another free zone person, which is derived from not from excluded activity. So you have a free zone entity which is performing activities not included as excluded activities. We'll see what is excluded activity. The second thing is that income from qualifying activities from it could be from mainland entities or free zone entities, but that activities should not be part of excluded activities. They have given a list of qualifying activities that we will see in the future slide. And any other income which is not part of the above two, but that is very minimal. When I say very minimal, it is less than de minimis threshold. So what is de minimis threshold? De minimis threshold is a non-qualifying revenue which is not exceeding 5% of total revenue or 5 million. So lower of this is considered as de minimis. So you have other income which is not part of the above two, but that is less than this de minimis threshold. Then also it will be considered as qualifying income. So in another way to say is that if a free zone company is conducting qualifying activities, you can have income from any entity. So that is considered as qualifying income. A free zone company is earning income out of excluded activities. Then whatever you do with whichever company you perform your activity, you will not get this benefit of qualifying free zone person. Your income will be subject to tax at normal rates. But if a free zone company is performing any other activity, you will get this benefit other than those qualifying and excluded activities. You will get this benefit only if you are providing this or doing this business with only free zone entities. This is how we can understand it. We'll see this later on a little bit more detail. And any other income which is a non-qualifying income in the hands of free zone person or qualifying free zone person, that will be state taxed at 9%. Irrespective of that, or we do not have any benefit of that 375,000 0% tax and more than the 9%. So even if we have 100 dirhams as income coming from these activities, or profit out of these activities, that will be subject to tax at 9%. So what are those activities? Revenue from immovable property in free zone. If it is a commercial property, to anyone we lend it out, or if it is a non-commercial property, to any commercial, so any person we let it out, so that will be subject to tax at 9%. Not only this, any revenue that a free zone company is deriving out of domestic permanent establishment or a foreign permanent establishment, then entire income that you derive or profit that you derive from that particular permanent establishment will be subject to tax at 9%. So what is domestic permanent establishment? It is a little bit more detailed concept to understand, but just to give a brief idea, a free zone company established in a free zone called, let's say Zabsa, but that has got one employee who is working regularly from his home, which is in mainland. So this place from where he is performing, this employee, so the activity performed by this person, whatever income he generates, is assumed to be a domestic permanent establishment. He's not going to Zabza office. He is not even visiting there. He is only working from his home in mainland. So the business that is generated out of this activities of the employee will be considered as income coming from domestic permanent establishment. So we need to be very careful whether we have office in free zone, are we going there and then doing the work from there or not, are we taking decisions from there or not. Likewise, even for foreign permanent establishment, if that same person is working from outside UAE and generally is being providing all the services from there, so then the activities of those that persons from outside will be considered as income from foreign permanent establishment, and that will be subject to tax at 9% straight. This will not impact your qualifying free zone person status, but only thing is that this particular portion of income will be subject to tax at 9%. That's the difference. So let's quickly look at the qualifying activities. They have given a list of activities in that decision. In terms of goods, manufacturing of goods or processing of goods in a free zone, that will be considered as qualifying activity. Distribution of imported goods or materials in or from a designated zone to a reseller. So this is a narrow definition or activity given as of now in the law. You are a free zone company, not in a regular free zone, but in a designated free zone, and you are in a distribution activity. Plus, your activity is such that you are importing goods from outside to the designated zone or from mainland to the designated zone, or you're buying locally within the designated zone and then selling them to another person. It could be anywhere, but that other person is a reseller. He is not the end user or end customer. He is a reseller. So he is buying from you and reselling it to someone else. If all these conditions are being met, then only your distribution activity will be considered as a qualifying activity. Mind you that you should be a distribution company in a free zone, designated free zone. You should be buying, means that goods are physically either being there in the designated zone or passing through the designated zone, and you're selling that to a reseller. So if all these are met, then only your activity will be considered as a qualifying activity. We'll look at this point a little later in detail with an example. I know there are some questions on it, but we'll look at them. So other services that are mentioned here, those services which already is falling in this will be considered as a qualifying activity. Just to name them off: holding of shares or other securities, ownership, management, and operations of ships, reinsurance services, fund management services, wealth and investment management services, headquarter services to related parties, treasury and financing services to related parties, financing and leasing of aircraft, including engines and rotable components, logistics services, ancillary activities to the above. So any activity that you perform with whomever you do business will be considered as a qualifying income, and you are expected to have 0% tax if you comply with other conditions we discussed in the previous slide. This list is a list of excluded activities. If you perform this business, make sure that be assured that you can consider that your business is subject to tax at regular rates of 0% or 9%. You will not get the benefit of qualifying prison person status. So this is a list. Any transaction that you do with natural person, except to ownership or management of ships, fund management services, or wealth and investment management services, financing and leasing of aircraft. So any service or business you do with natural persons other than this will be considered as excluded activity. Banking activities, insurance activities other than reinsurance, financing and leasing activities other than financing to related party and financing to aircraft. So any other financing activity or leasing activity will be considered as excluded activity. Ownership or exploitation of involved property except to transaction with another free zone person related to non-commercial property in free zone. Intellectual property, asset income, and any other ancillary activity to the list mentioned above. Any activity that you perform out of this list will be considered as excluded activity. Then your income will be subject to tax in normal rates. So this is a summary of what we discussed. It's a table that is given just to arrive or understand how we can arrive to the applicability of it. Just to give an example, you are a qualifying prison person and your source of income is what we have to look at. If your source of income is from a non-prison person, in which case we need to see, are you performing a qualifying activity? If yes, then your income will be considered as qualifying income, and then it could be subject to tax at 0%. That's how we need to understand. So this slide, as well as the following slide, is just to help you in understanding, or whatever we discussed in previous slides, just be drafted in a different way to understand. So we'll share this presentation anyways to you, so you can look at that for your reference purpose. By considering the time, we will not look at this in detail, but you can refer to this later on. Let's take up an example with respect to this free zone concept. You have a manufacturing company in a free zone. So that could be in normal free zone or designated free zone. And you're selling this, doing this manufacturing activity for a contractor. So you're simply, whatever contractor asks you to manufacture, you're manufacturing and giving it to them. So that becomes a qualifying activity. And whatever income you generate as a free zone company by performing this manufacturing activity becomes a qualifying income, and you could be falling under qualifying free zone person status. So it is very straightforward. Let's take an example of a distribution activity. So distribution of goods or materials in UAE, the designated free zone person, which is a distribution company, buys goods from country A and sells these goods to a retailer in UAE. The distributor company earns profit or margin on the goods sold to the retailer, of course. The goods are shipped by the manufacturer in country A to distributor company in designated zone, from where they are imported and into the UAE. So which means if you are a free zone company in designated zone, you are buying goods from a manufacturer in country A and selling goods to a retailer in UAE, in mainland. And in this process, you are bringing those goods physically from outside UAE to designated zone, from where you are supplying it to a retailer in mainland. So if this is the case, so whatever transaction you're doing will fall under this qualifying activity, and whatever income you generate out of this activity becomes a qualifying income, which may be subject to tax at 0%. So as I mentioned, you are a distributor established or located in a designated region. You are buying from a manufacturer and goods are physically routed through designated zone, and you're selling this way retail in mainland. So all these conditions have been met. So your income will be subject to tax at 0%. Let's take up another example. This example we have picked up from public consultation document. This public consultation document is a document issued by Ministry of Finance with respect to free zones. They wanted to take opinion of the public with respect to some of the transactions or all the transactions that are mentioned in the public consultation document. So this public consultation document is not part of the law. So we should not be considering this to take any decisions. If FTA comes up with any clarification or any amendment to include these, then we have to consider that as a basis to take any decisions. For now, we are only talking about this just for your information purpose. This kind of arrangement at the moment are subject to tax at normal rates, and this is not part of a qualifying activity. So, but I'm discussing this because it is mentioned in the public consultation document, and they mentioned this as a qualifying income or qualifying activity in the public consultation document. In the law, it is not mentioned as a qualifying activity yet. So what is that example? So distribution of goods or materials from outside A. Designated zone prison person, which is a distributor company, buys goods from manufacturer in country A and sells these goods to a retailer in country B. Distributor company earns profit or margin on the goods sold to the retailer in country B. The goods are shipped directly from manufacturer in country A to the retailer in country B. This is what generally happens in the case of third port shipment. Or it could be high sea sale also. So you are buying from a manufacturer in country A. You are a distributor in designated zone and you're buying the goods from a manufacturing country A and selling these goods to a retailer or distributor in country B. The goods are physically not coming to UAE or designated zone. They are physically moving directly from country A to country B. So in public consultation document, they mentioned that this activity could also fall under qualifying activity and income generated out of that will be a qualifying income. Okay, that is what is mentioned. So you could be attracting 0% tax on your profit. As I mentioned, this is only mentioned in public consultation document, but as per the interpretation that we have presently in the law, this transaction arrangement will not fall under the qualifying activity. And that activity may be subject to tax at or will be subject to tax at 9% at the moment. Okay, so you need to wait and see if they are going to come up with any clarification or anything.